I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a money manager with about $400 million under management. He's one of our favorites here, Axel Merk of Merk Investments. Thank you for coming to us from California to talk about what's going on in the financial world. And I got a lot of questions for you. Axel Merk, thank you for being here.
Great to be with you, Greg.
I want to start with, and I don't have big money. I manage about $10. But, I look at this Greece thing, and the communists that got into power, Syriza, said, we're going to have no austerity. Not a little bit, not some, not cut back on it. They said, we're not going to have any. And they're digging their heels in. And Germany hates it. They want them to pay their money back. And the banks have been downgraded by S&P, and I'm just giving you a little, setup here. But what's going to happen if we come to this situation where Greece says, hey, that's it, we're not paying it back? Russia's offering them, deals to, financial help. And then what happens with Italy, Spain, Portugal, Ireland? We want the same deal. We want a debt cut. So isn't Greece the canary in the multi-trillion-dollar coal mine of debt that is Europe and European banks?
Well, in some ways, but let's take it step by step. First of all, think about what is in the interest of which stakeholder, right? The Greek, for the longest time, they had a little all-nighter, they promised everything, and they could live happily ever after. The reason why Europe has been doing these bailouts is because the banks in Europe held the debt of these weak countries. And so German banks, other banks held debt of Greece. That was a couple of years ago. Who owns Greek debt now? It's the IMF, the EU, the European Central Bank, hedge funds. But the banks don't own it as much anymore. And so, last week what happened was that the new finance minister went to the European Central Bank, had a chat with them, and afterwards the European Central Bank came out with a statement saying, we'll cut you off from our funding in 2 weeks, earlier than previously expected. Not from all the funding, but we'll kind of shoot across your bow. And sure enough, the euro tumbled on that. By the next morning, the euro had recovered. The reason the euro had recovered is because Greece's problem is mostly Greece's problem now. Now, you're making a good point, of course. Well, what about Italy, Spain, and so forth? The biggest fear Northern Europe has is that anti-austerity parties are becoming more popular. Now, in Spain, there's a surge of an anti-austerity party. And the best thing really to happen is if there's a meltdown in Greece from the point of view of Germany, because if there's a meltdown, that would kind of discourage the Spaniards from going the same path. And so the roles have a little bit changed here. Germany, I think, knows that the money is gone, but they can't give in because everybody else will give in then. So if you want to take a haircut, you can do it, but you're going to be on your own and you're going to suffer the consequences. And I think that's the road we're heading in.
Do you think that's a risky strategy? I mean, with all these derivatives with this debt, I mean, if nobody really knows the real exposure. If this thing gets out of control, couldn't we have like bank runs all across Europe? Couldn't we have just fear and panic take over? I mean, aren't they rolling the dice on that? Isn't there a downside?
Well, in some ways, yes. 2 years ago, I would have said we're going to have financial meltdowns. These days, if you look at how the market has reacted, and the market has kind of been pretty complacent about it. Now, why has the market been complacent about it? I think a key reason the market has been complacent about it is because the banks have had time to prepare. If you think about it, it used to be that financial institutions thought this peripheral debt is debt-free. And so if suddenly that debt is risky, well, you're not supposed to be holding it. Whereas now everybody knows this stuff is risky. And so the institutions have had time to prepare, and that's ultimately the role of central banks. Central banks can buy time. They cannot buy solvency. And that's why, yes, there will be an impact. Yes, there will be nervousness. I don't think there's going to be a meltdown. I think it's going to be more like Cyprus. In Cyprus, there was a meltdown in Cyprus, but the ripple effects were limited. And so, yes, it's bad, but it's mostly bad for Greece.
Well, but the meltdown will come to individual depositors, won't it? I mean, that's where the meltdown will happen.
That's, of course, the big question here. In Cyprus, the Dijsselbloem, the head of the Eurogroup, he's in charge now. He, at the time, said, Cyprus should be an example, a roadmap for how these things are going to be handled. Then he backpedaled a little bit. No, the small depositors we're going to save. Well, the question is, how do you save depositor if you have a government that you can't negotiate with? You have a bunch of communists in suits that grin all the time, but they don't really do what they're going to say. And so the question is, of course, well, why on earth do you have to have your deposit in a Greek bank? The the Greek people could have the deposit in a Spanish bank or put it in a German bank. And of course, some of them doing it, they're voting with their feet. But yes, they're going to try to rescue the depositors. And by the way, everything is about playing to your domestic audience. In Germany, there's plenty of sympathy to bailing out the small depositor. So they will come up with a plan for that. But that doesn't mean the government can function. That doesn't mean the economy can function. And so that's really where the fallout is going to be if there's a meltdown, that the Greek economy is going to melt down, and then they might find a solution. I think there's going to be a willingness. The question is there going to be somebody that you can strike a deal with?
Well, what happens if they turn around and they say, hey, Russia, we'll take you up on your offer of a help out, and we'll just leave we'll leave NATO?
Of course, that's possible. Russia, though, has put a dampener on that and said, well, we'd have to have a close look and review this a little bit. Remember, in Cyprus, it was the Russians that had their deposits in Cyprus, and so Russia had a very strong incentive to help there. Here, there are some ideological similarities, but don't forget that Russia has some issues as well. And so a lot of this is sales talk, but Russia isn't exactly in a position to help out right now. And the big problem that of course Greece has is time. Right, by the end of the month, they need to find an agreement to extend certain provisions. Some people have said they have money till the summer. Now some people say they only have money till 2 weeks or so. Ultimately, what do you do when you have somebody who is very charismatic but comes up with new ideas that are completely out of the concept you've had right now? And some of these ideas might even be good, but you're going to stick to the protocol. And if you're Northern Europe, and that's what they're doing. Hey, tell us what you have, and it's a high-stakes poker game. Let me phrase it another way around. Think about the U.S. budget, right? President comes out with a budget proposal which has absolutely no chance of being passed. The reason the markets don't get nervous is because we know how this game plays out. The difference is that here we have a player that we don't really know yet. But ultimately, it's a high-stakes political poker game, except that I think the Greek are overplaying their hand because Northern Europe is going to be quite willing to let them melt down.
Whoa. So you think they will melt down, and you'll say, okay, Greece, you're going to melt down, and Spain, take notice. They're going to melt down. Watch this.
They're just too far apart. The Greek finance minister spoke with the German finance minister, and I didn't see any common ground amongst the two. They're very far apart, and they don't have much time. That's not a very good combination. And so...
Could they just throw their hands up in the air, Greece, and say, okay, you know what, we're defaulting. We're going to go back to our drachma. We'll have inflation. We'll make it. It'll be okay. We have natural gas around Greece. We'll make it. It'll be tough, but we'll make it. Could they just default?
Well, of course they could, but they probably need the Germans to help them how to do it, right? I mean, they don't have the know-how to implement a proper exit. That's why sovereign defaults are pretty messy. I mean, these guys have done a pretty good job. They're in power for a few days. They put a government together. They're whisking around Europe, and they're giving big talks. It takes a little bit more than that to set up a new banking system. And so, yes, they can try, but ultimately it's going to be very rough. Now, having said that, it's going to be rough at some point, so it might as well be now.
Are you worried about the banks with this big downgrade from S&P? Downgraded tons of banks over in Europe. Deutsche Bank, I believe, is one of them, and they have a huge derivative exposure. I mean, you start. I know Germany is strong, but I mean, it's a $4 trillion economy.
A central bank can always keep a zombie banking system afloat. We've seen it in Japan. We've seen a financial crisis in the U.S. We've seen it in Europe, and so you can always provide liquidity. What you cannot provide is solvency. And that's the thing. If you suddenly don't have a team player anymore, if Greece is not a team player in the sense of what the European family wants to have a team player, then they can be out. But even if you're technically insolvent, a central bank can keep a system afloat. We have seen how the game is played out. Now, that doesn't mean you can't have nervous markets. That doesn't mean you can't have a stock market crash or this or that. But it's not the end of the world, so to speak. It is far worse if you're in a situation like Iceland or Cyprus, where you have a meltdown because you get the rug pulled from underneath you. And you get that when you have a government that's no longer functioning. And see, that's really the bigger threat. But because of all the things that have been put in place and because we know the game plan, I think ultimately the Greek people are going to be suffering the most. And yes, some traders are going to lose a lot of money. But I do think the banking system as a whole is probably going to stick around.
Are you worried about this, Hollande and Merkel last week flying to Kiev and Moscow to try to cut some kind of a deal in the Ukraine, as sanctions are ratcheting up, as NATO keeps continuing to pour, military might and manpower into Eastern Europe. Does that worry you? Does that have an effect on your investment theme?
Well, I mean, it would be good for European growth if there weren't sanctions in place, no matter where you stand politically on this issue. The one positive I took from that is these guys have been traveling around. That must mean they probably like each other. And that hasn't always been clear in some of the discussions they've had. And I think that will be very important in the discussions with Greece. If these two guys, or guy and gal, have been chatting a lot, I'm sure they've talked about Greece as well while they're on the plane. And so in that sense, there's going to be probably a more united front. So that's a positive. Now, talking about Russia, yes, I'm very concerned about Russia. I'm very concerned about what's happening with Ukraine. The problems we have there in Europe, and in fact also in Japan and the U.S., is we cannot budget our budget. We cannot balance our budgets. Ukraine wouldn't be in a situation it is in if it were able to balance its books. So that's just a symptom. It exhibits differently. We see one way how it plays out in Greece. We see Ukraine another way. In Japan, we're trying Abenomics. In the U.S., we have our feel-good growth strategy. But ultimately, we have the same issues everywhere. But yes, I'm very concerned about it because, the Great Depression ultimately ended in World War II. And there's a reason for it, because extremism, populism is on the rise when you have this dragged out period where everybody's trying to postpone the inevitable, then people get fed up with austerity and they start to blame everybody but themselves.
Didn't we get into this problem because we have more debt now than ever? We vaulted up the debt. The BIS and derivatives are debt, as you know, says we have 1,000 trillion in derivatives. We made it worse. We went from 700 to a quadrillion. That's the official number. Some people say it's twice, two and a half times that. But isn't the problem that nobody wanted to take a hit? Nobody wanted to write down debt. They just wanted somebody else to take the hit. They wanted they wanted the central bank to print money. And to your point, you can have liquidity, but you can't have solvency. So basically, the world is insolvent, is it not?
Well, much of it is. And ultimately, the best short-term policy would be a good long-term policy. I happen to be of the view that you shouldn't be policing that banks don't make stupid moves. What you should be policing is that the stupid move of a bank cannot wreck the financial system as a whole. And if you were to take that attitude, you would have a very few simple rules. You'd have to post collateral for levered transactions. You'd have to have mark-to-market accounting. And then you can have a few other little things, but you're pretty much done with it. And you let people do the crazy things that they want to do. Greed is part of markets, and if you kill that, you kill economic growth as well.
Well, and then we all should just have, if you believe in capitalism, you should believe in bankruptcy. If you're that stupid and incompetent,
But the problem we've designed a system where bankruptcy would cause a financial meltdown. And that is where we have to get away from. It's not that bankruptcy is bad, it's the contagion that is bad. And the way you avoid it is by posting collateral and levered transactions. If all these derivatives you're pointing out, people would have to post collateral and have mark-to-market accounting, they would be discouraged from taking such extreme positions. That is the problem. And we get into this with super loose monetary policy. When interest rates are zero, of course you gear yourself up. It doesn't cost anything to have yet another derivative in place.
And so Draghi is going to print, $1 trillion or something, over $1 trillion in more funny money to buy bonds to prop up the banks because the S&P downgraded all these banks. So we do know the banks are in deep trouble, and that's what their main reason what he's doing this. So what's the end game here? Are you forecasting inflation eventually? We have this big conversation all the time about deflation and inflation. Some of the smart people say, well, inflation first and deflation first and inflation second. But how are you positioning yourself? Do you see big inflation? Are they going to miss? Are the big central banks, the U.S. and ECB, going to miss the inflation threat and all of a sudden find themselves knee deep in huge inflation?
For me, it's a slam dunk we're going to get inflation. We have negative real interest rates in the developed world as far as the eye can see. Just about every country has negative real interest rates, so we have financial repression everywhere. I think we cannot afford positive real interest rates over an extended period. Just think about the U.S. with the entitlement wave coming against us. We're going to have strong incentives in place to have negative real rates when the government has too much debt, when consumers have too much debt. And yes, sure, currently inflation is low. The reason, by the way, we have this battle between inflation and deflation is because we're faced with a deflationary bust, and central banks are fighting against it. If we didn't have central banks, I would be fully on board. Yes, we'll have a deflationary bust. But because of the reasons we discussed, that we cannot have bankruptcies, we do this and this, we will inflate our way around it. And Draghi is a good case in point here. I don't think it's necessarily to bail out the banks. I actually think that the policy has no sense at all to buy these bonds. The only thing he's trying to achieve is weaken the euro. And in order to make it a little bit easier to induce a little bit of inflation. But I think it's extremely difficult to induce inflation when banks are impaired, when banks don't really want to lend, and when there is no demand. Solving the Ukraine crisis has a much bigger impact on inflation than trying to print money. And so he's going to fail with that, but ultimately inflation is probably first going to come up in the U.S. and it's going to be exported to those countries. And we call it stagflation when you don't have growth, and then you have inflation after all. And depending on the country where you are, it's going to be a little bit different. Now, how do you play this? I think investors should have their toolbox, just as Bernanke had his toolbox. I'm very concerned about equities and bonds, both of them at the same time. Now, clearly, if you print enough money, bonds and equities go up. The problem is everything goes up in tandem. So people need to look at alternatives. The easiest one is gold, but gold is not risk-free when your daily expenses are in dollars. There is no risk-free asset to hide. I think that's the key thing people have to realize. As you know, we do a lot of currencies. The reason we do currencies is because you can design a strategy that is uncorrelated to your other investments. But that's not the answer to everything either. You've got to look, though, at alternatives. You've got to look at finding ways to truly generate uncorrelated returns so that when volatility goes back, you have a way to hide. And by the way, the reason you need to hide then is that everything else equal, when volatility goes up, asset prices go down. And the one thing central banks have achieved is they have made people complacent. Risky assets, be that stocks or bonds, don't look risky anymore. And so when the Fed tries to do an exit, even tries to do it, asset prices plunge down. You've got to hide somewhere.
Axel Merk, you have a investment conference coming up, I think, at the end of this month. Tell me how people should get involved in that. How can they sign up for that?
Oh, sure. Well, we have numerous webinars, at least one a month, and the upcoming one is about how to use gold in a portfolio in an era of financial repression to find out ways that what can you do with gold, the pros and cons, how much should you use it, how should you position the portfolio. And if you go to Merk-Investments.com, there's a link to a webinar sign up, and I believe you put one up on your site as well.
I'll put one up, and this is free, right? It's totally free to people.
Of course. Axel
Merk, Merk-Investments.com. Thank you so much for coming on and giving us your view. You got a lot of geopolitical and financial stuff to try to manage $400 million, and thank you for giving us your insights.
My pleasure.